We start the discussion of Chapter 2, Healthcare Insurance and Reimbursement Methodologies. The, um, the way third-party payers pay hospitals can get very complicated because it might be difficult to judge the quality of services. There is several codes involved, and that makes all of the process very difficult and also the methodologies. So, although some provider revenues come directly from patients when they pay out of pocket, a vast majority comes from insurers, a vast majority. Because as you know, a lot of the people are insured. Well, there are some that are not insured, but there is a vast majority that is insured, and other entities, and they are all collectively called as third party payers. Now, that includes Medicare, Medicaid, as well as private insurers. Because revenues are essential to financial success, health services managers must understand the healthcare insurance system and the methodologies that payers use to reimburse providers. So there is some basic characteristics of insurance. For insurance to work, there should be a pooling of losses. When we talk about pooling of losses, we are saying that your losses should be spread over a large group of individuals. Payment only for random losses. If there is any unforeseen, unexpected, and by chance occurrences, the payment by insurers will be done only for that. Because if you already know, if you have a predisposition to, let's say, a certain disease like hypertension and diabetes, you will buy insurance for sure. And you will buy the most expensive insurance because you already have this underlying problem which you know about. It is not unexpected. So then insurance is not going to pay for it because it is not an unexpected occurrence. If they already know that you have diabetes, they'll ask you to pay a higher premium, right? Because you already have that problem. So insurance really wants to pay only for random losses like accidents and so forth. The risk transfer should be there, which means that you should be able to transfer risk from an insured to an insurer. So the when the person is insured, for example, let's say you are insured as a patient and you pay a premium of $200 a month, um, that once that occurrence happens, your risk of payment has to be transferred from you to the insurer, and now it becomes the insurer's responsibility to pay all of those financial obligations. And then the last one is indemnification, in which there should be a reimbursement to the insured if a loss has occurred. So I've also have another video on understanding a simple illustration of concept of insurance, um, and I'll post that link. But basically, what it is saying that if let's say your outcome is healthy and your probability of being healthy is 99% and the cost to you is zero, but if you get sick, the probability is 1% and that the cost is 20,000. Even if the probability is very, very less, the cost is very, very high. And the expected cost is calculated as the probability uh, of, of that outcome multiplied by the cost of that outcome. So if you calculate the expected cost, the cost comes to $200 because it's 99% multiplied by 0 plus 1% multiplied by 20,000. So you can make, and the total is $200. Now, if you're making $20,000, it is possible for you to pay $200. But your bill will never be $200. It will always be in the neighborhood of $20,000. And because you're risk averse and you want to avoid the possibility of paying that much, you will buy a premium, buy an insurance in which you have to pay a premium of $250. Now, even if there is an additional $50, um, more than the expected cost, which is $200, you will still buy it because you want to avoid that huge $20,000 bill. So there are some issues that insurance programs face. There are two problems that often arise in insurance programs. The first one is adverse selection. People who are already sick, from let's say they have some chronic issues such as kidney disease, high blood pressure, high sugar, they are more likely to purchase insurance. Older people are more likely to purchase insurance. People who need surgery, they are more likely to purchase insurance. If only sick people come, the premium for the healthy will be very high. And therefore, we need a diversified risk pool, and that is a problem that insurance faces. The other problem that insurance faces is moral hazard. The owner deliberately sets a failing business on fire to collect insurance. That is a moral hazard. Or you go to the office just to hang out, just to socialize with the doctor, um, just for human companionship, not for any medical necessity. And therefore, what insurers do is they ask you to pay a co-insurance where you have to pay like a 20% out of pocket, or a co-payment where you have to pay $20 out of pocket. So again, reiterating a little bit, adverse selection is where those who have a greater risk are more likely to purchase insurance, and the problem happens because there is asymmetric information. People who know their health status, they already know that they have diabetes and all of that, they will be more likely to buy insurance, and they will be more likely to buy expensive insurance. In the past, insurance companies used underwriting provisions to minimize adverse selection. And then there is cross subsidies that often exist among different groups, and that is also helpful to minimize the problem of moral hazard. The adverse selection. So, in moral hazard is the overuse of health services or foregoing of prevention because the insured does not bear the full cost of the consequences. And to overcome that problem, they have a system where they ask you to pay a high deductible. So unless you pay like a $2,000 deductible for your family or a $1,500 deductible for yourself, the insurance never even kicks in. You pay a co-payment of $20 for every visit you make to the doctor. You pay a co-insurance of 20% out of pocket for every visit that you make to the doctor. And there is stop loss limits and policy restrictions within the policy itself, where you may not be allowed to do certain things, or you also have like 10 visits in the year for acupuncture, for example, and those are the ways that moral hazard is overcome by insurers. For the most part, provider revenues come from third-party payers rather than from patients. Patients, they don't pay out of pocket much. They have some or the other kind of insurance, particularly in the United States. So some private insurers examples are Blue Cross Blue Shield, commercial insurers, self-insurers, and public insurers, like I told you before, are Medicare and Medicaid. However, all of them together are known as third-party payers. Some other examples of commercial insurers are Aetna, United Health Group, and self-insurers can usually be wealthy people. They can be large employers. Example: employees of the NSHE, Nevada System of Higher Education, and public insurers like United States Department of Health and Human Services. Medicare is for ages that are 65 and older, and Medicaid is for low-income and disabled people. Managed care plans, for example, the HMOs, theoretically, they have a strong incentive to prevent illness than to treat them. They use the primary care physician as the gatekeeper, and the PPO is where people can use providers that are members but they don't have to. So, managed care describes a continuum of plans which can vary in their approaches to providing combined insurance and healthcare services. They strive to combine both the provision of healthcare service and the insurance function in a single organization with the purpose of increasing quality care and decreasing cost. And if you are asked in general, the purpose of managed care plans is to control cost. And how do they do that? They control cost really by doing preventions. They do a lot of screening, for example, cancer screening, and diabetes prevention management, hypertension prevention management, healthy diet, exercise, nutrition, and so forth. And they do prevention based on all of that.